Hello, you're watching the weekly wrap-up. This is where we take a look at the last 5 days to see what moved and shook the markets. Well, joining me on the line is Jonathan Webb, Head of FX Strategy at Jefferies Bache in London. Mr. Webb, welcome. Let's start with the delayed US data we finally received this week. Delayed NFP figures disappointed and decreased to 148,000 in September, and we saw then a less than impressive jobs report. But it wasn't overall too bad. Could you talk us through the delayed NFP and what this could mean for tapering by the Fed in the near term?
I think it is an important. It does have an important impact in that it's very easy in terms of look at tapering to see how it can actually be delayed significantly, and probably the only thing that could have maybe changed that was the employment report. And one of the issues that we see from the Fed is that they don't seem to really trust the ISM data. That's obviously has strengthened, and their primary focus is on the employment report. So it did mean that this number was important. But I think the other thing to mention about the non-farm payroll is that they could well be distorted next month because the government was closed during the survey period. So it's actually going to be quite hard, I think, to actually get sort of clean data from here, and it could even be into January before we get clean data. And you just look at the timing of the meetings, and in that world, it's very easy to get to March before they're going to taper. And I think that is a significant change in the market sentiment, clearly from the September expectation. We see that as a dollar negative.
Now, another market mover this week has been the strength of the euro. In fact, some companies have even cut their revenue forecasts because of the rally we've seen this week. What's happening here exactly?
The most interesting thing about the euro, which really fits in with the whole US QE story, and I think it's very underreported. We all spend a lot of time talking about this $85 billion balance sheet expansion from the Fed. What seems to be getting a lot less attention, and something that we've really focused on heavily for the last couple of months, is that the repayments of the LTROs by the ECB are actually leading to a contraction of the balance sheet, and it's actually a very sizable contraction, $65 billion a month on average. And I think it's really the combination of the two. The fact that the Fed balance sheet is still growing, but also that the ECB balance sheet is contracting. In many respects, you'd say, there's a very simple solution to that. The ECB just does more LTROs, and the balance sheet starts to grow. However, it's very clear from the core countries, coming from Wiedemann and Corey and Not actually this week, who are really against LTROs on really quite a sensible basis, and that is they're trying to sort of move the banks away from their dependency on the domestic economies, and that's the whole move of this sort of this banking, this first step in the ECB regulating the major banks. But actually, LTROs just tie the domestic banks, closely into the sovereign, and really that was a source of the stress last time. The very large holdings of bonds by the banks, and so there's good reasons to think that the ECB, is going to be quite reluctant to offset this balance sheet contraction, and it's something that we've been highlighting for a while. Is the risks to us on the upside on the euro dollar, and I think it's perplexing if you look at the relative economic performance, but I think if you look at it in terms of this relative balance sheet move, it's much easier to see why the euro dollar can actually move higher.
The other key news affecting the markets this week happened today, and that's the second consecutive rise in GDP for the UK. Can I safely say the UK is now growing again?
I think we can say that, and in fact, I would go further. I would actually say the risks of an upside surprise are much larger than the risks of a downside surprise. And something I often say. I said, it's a country. We're a country obsessed by housing, and house prices are starting to move up. I think the Help to Buy scheme, clearly, is more suitable for the electoral cycle than the economic cycle. Just as the economy and housing is picking up, probably don't need a return of 95% mortgages. So for us, I think there could be a surprise, in terms of GDP and in terms of the Bank of England. This idea that they're on hold to 2016. I think that the risks that the market will revise that significantly. That hike significantly closer to maybe end of 2014 or 2015. And I think there's actually still upside for sterling in that environment.
Just before we go, Jonathan, the foreign exchange market is still pretty nervous despite a recent spate of positive news. Are growth problems in China still the main cause here?
In a world where you expect what should be relatively good risk performance, and everyone should be you'd expect markets to be doing better. I mean, it is notable that particularly there's been some nervousness about tighter policy in China, and it's had quite an outsized effect on the market. And I think it just shows you that even though in some respects you'd say the environment is constructive, particularly in terms of Fed's continuing QE, it does show you that I think that things like the Aussie have suffered really just on the back of fears that things aren't going so well in China. And I think it just illustrates that really that the FX market is still quite nervous after the events of the last couple of months.
Okay, that's all for today's weekly wrap-up. To check out other interviews and updates, click back to our homepage and take a look at the Forex and Analysis section. I'll see you next week though. Goodbye.